You paid the tariff. Somebody else got the refund. And I am not being cute with that sentence, I mean it almost literally, because this quarter, the receipts finally showed up in public filings, and you can read them yourself. About $175 billion was collected at the American border under a law the Supreme Court has now said never allowed it. That money is coming back. It is not coming back to you. And the best part, if you have a dark sense of humor about these things, is that nobody even had to hide where it went. They wrote it down. In the filing, on the profit line. Let us go back to February 20th of this year. The Supreme Court rules, 6-3, that the International Emergency Economic Powers Act, which is an emergency power statute from the 1970s, does not give a president the authority to impose tariffs. Not narrowed, not sent back for more argument. It does not authorize this, which is a genuinely enormous ruling, because by that point those tariffs had been running long enough that importers had paid roughly $175 billion in duties on goods coming into the country. That is real money that already left real bank accounts. And the ruling did not say what happens to it. The reaction was basically unanimous across every political direction, which almost never happens. This was framed as a win for regular people. The tariffs were a tax on consumers, everyone said correctly. Prices went up because importers passed the duty through to the shelf. So the court striking it down means the money comes back. You paid it, you get it back. Justice is slow, but it arrives. That was the story. Millions of people shared some version of it. It is intuitive. It is satisfying, and it is the part everybody stopped reading before. Except, the refund does not go to whoever paid the price. It goes to whoever filled out the form. Here is the mechanism, and it is not a conspiracy, it is just plumbing. When goods enter the United States, one legal entity is listed on the customs paperwork as the importer of record. That entity is the one that actually hands the money to customs. Usually that is the company bringing the product in, sometimes a customs broker acting for them. It is never, ever the person who eventually buys the sweater. When the Court of International Trade had to decide who gets refunded, it ordered Customs and Border Protection to pay back the entities that directly paid the duty, which is legally clean and completely logical. Customs has no relationship with you. It has never heard of you. It cannot refund a person it has no record of. The consumer is downstream of the entire system, which is exactly why the cost could be passed to them in the first place, and exactly why the refund cannot be passed back. And there is a second filter on top of that one. On April 20th, Customs launched a system called CAPE to process these claims. It does not refund anybody automatically. A company has to come forward, identify its entries, document the duties it paid, and file. Which sounds procedural until you think about who can actually do that. Company with a trade compliance department and outside counsel can reconstruct 4 years of customs entries and file in weeks. A small importer who has no idea any of this is happening may simply never claim it. So the refund flows fastest to the largest and best advised, which is not anybody's villainy, it is just how an opt-in process works every single time. Now, up to this point, everything I have told you is a prediction about where money would end up. As of this quarter, it is not a prediction anymore, because the filings are public. Carter's, the children's clothing company, disclosed that it recognized approximately $128 million as a reduction of cost of goods sold, plus $4 million of interest income. Stanley Black & Decker disclosed a pre-tax gain of $118 million in cost of sales. Tariffs received about $29 million, 26 of which went to cost of goods sold. Hubbell received about $30 million. These are not estimates. These are the company's own words in their quarterly reports to the Securities and Exchange Commission. But I want you to read the actual sentence, because this is the whole video. The recovery is recognized as a reduction of cost of goods sold, quote, for amounts related to goods already sold. Meaning the sweater is gone. Somebody bought it. They paid a price that had the tariff baked into it. And now the duty on that specific, already purchased item comes back to the company as a reduction in what that item cost to sell. The margin on a completed sale gets improved retroactively, months later, by a court ruling. That is not a loophole and nobody is hiding it. It is the correct accounting treatment under a standard called gain contingencies, and every one of these companies applied it properly. That is what makes it remarkable. This is the system working exactly as designed, in public, in plain type. Okay, now the honest part, because I would rather you trust me in 6 months than agree with me today. 3 ways this could be less damning than it sounds. First, and most importantly, nobody knows exactly how much of a tariff consumers actually bear. Economists have argued about tariff incidents for a century. Importers eat some of it in their own margins, suppliers eat some, consumers eat some. The split differs by product and by how much pricing power the seller has. So when I say you paid it, the honest version is that consumers absorbed much of it, not all of it, and a company that genuinely ate part of the duty is genuinely owed part of that money back. Second, none of these companies did anything wrong. They paid a lawful-looking duty, a court struck it down, and they filed for a refund they are legally entitled to. If you are looking for a villain, here you are going to be disappointed. Third, this is a one-time item. It flatters this quarter and it disappears from the next one, so anyone extrapolating these margins is going to be very surprised in 90 days. And a real chunk of that 175 billion may never be claimed at all. What do you actually do with this? Two things, and neither one of them is a trade. First, as an investor, you now have a margin distortion running through an entire category of importer-heavy companies. Retail, tools, industrial equipment, anything that brings physical goods across a border. If you look at a gross margin line this quarter and it looks like operational genius, check the filing for a tariff recovery before you believe it. Normalize it out. Market is currently very bad at distinguishing a one-time legal windfall from an actual improvement in a business. Second, as a citizen, just understand what happened structurally, because it will happen again. A cost was imposed at a choke point, passed downstream to millions of people, ruled illegal, and then refunded upstream to the choke point. $175 billion collected, $0 refundable directly to any consumer. Not because anybody stole it, but because the plumbing only runs one direction. Here is my call, and you can hold me to it. By the third quarter reporting cycle, at least 5 more S&P 500 companies will disclose a tariff refund recognized in cost of sales or as a reduction of inventory. If fewer than 5 do, I was wrong and I will say so. Thing I keep coming back to is that nobody had to cover this up. It is in the thank you, in plain type. On the cost of sales line, correctly accounted for, audited, filed. The clearest transfer of the year sat in public documents for weeks, and it took a viral post for anyone to go look. So here is the question. If the tariff was a tax on consumers when it was collected, what exactly is it when it is refunded to somebody else? Tell me below. Actually want to know how you land on that one. And the full market picture for today, records on the Dow and the S&P, the credit market repricing the artificial intelligence trade, and Bitcoin slipping under its 200-week line, is in today's daily brief, linked in the description. Research and education only, never financial advice. I am Frankie, the asymmetric signal. One contrarian read a day. Subscribe.